You know, when you look at a financial report, it can just seem like a wall of numbers, right? But inside all that data, there's always a story. And today, we're going to put on our detective hats and uncover a really fascinating and honestly, a kind of contradictory story from a company called Archean Chemical Industries. All right, let's jump right in.
So, here's the plan. First, we'll get to know the company. Then, we'll look at two very different quarters. It's like a tale of two cities. We'll dig into the revenue and expenses to see what went wrong or right. Then, we'll uncover a pretty surprising twist in the company's foundation. And finally, we'll wrap it all up with the big takeaway.
All right, first things first. Who exactly are we talking about here? Okay, so Archean Chemical is what you'd call a specialty manufacturer. And get this, they operate in just one segment, marine chemicals. Now for us, this is actually a huge help. It means their business is super focused. Everything we're about to see, all the numbers, they all point back to this one core operation. It makes the story a whole lot easier to follow. Okay, now we get to the real heart of the mystery. We're going to compare two key periods, the last quarter of fiscal year 2023 and the second quarter of 2024. And as you're about to see, the difference between them is, well, it's pretty staggering.
Just look at this. On the left, back in Q4 2023, Archean had a really strong net profit. We're talking almost 1.4 times billion Indian rupees. Pretty good, right? But then, fast forward to Q2 2024 on the right, and that profit has just cratered down to just under 219 million. Wow! I mean, that is a night and day difference.
So to put that into perspective for you, that's a drop of over 80%. 80! You know, when you see a number like that, it just screams something happened here. The profit didn't just dip a little, it completely fell off a cliff. So the big question, the one we have to answer is, why? And that is the central question for this whole explainer. What on earth happened inside this company to cause such a massive, massive drop in just a couple of quarters? To find the answer, we've got to dig deeper into the numbers.
All right, to solve this puzzle, we need to pull up the income statement. Think of it this way. It tells us where the money came from, that's revenue, and where it went. Those are the expenses. Let's see what the story is here.
Okay, let's walk through this together. First up, revenue. You can see it fell, and fell pretty hard, from 3.8 billion down to 2.4 billion. Ouch. But then, look at total expenses. They went down, but not nearly enough to explain the profit drop. And then, we see it, the big clue. This line right here. Exceptional items. These are one-off costs, things outside the normal day-to-day business. It was zero in that good quarter, but it's a massive negative 400 million in the recent one. That, my friends, is our smoking gun.
Yeah, the drop in sales definitely hurt, but it doesn't get you to an 80% collapse. Like the slide says, the real story here isn't just that they sold less. It's that this giant one-time cost just appeared out of nowhere and landed on the books. Over 400 million rupees. That single line item, which, by the way, the report says is a one-off event, not tied to their usual operations, it just completely wiped out a huge chunk of what would have been their profit. So, okay, we found the main culprit for that scary profit drop. But believe it or not, that's not the end of the story. And now we're going to pivot. See, the income statement tells you about performance over a period of time, like a race. But the balance sheet, that's like a checkup. It's a snapshot of the company's fundamental health, what it owns versus what it owes. And this is where things get really interesting, because we find a totally surprising counter-narrative.
So let's start with a baseline. Back in March of 2023, the company had about 17.6 billion rupees in assets. That's all the stuff it owns. And on the other side, just 3.2 billion in liabilities. That's what it owes. I mean, that is a really healthy position to be in.
Okay, now look at the more recent snapshot from September. During the exact same time that profits were tanking, two really incredible things happened. First, their total assets actually grew to over 20 billion rupees. And, maybe even more surprising, their total liabilities, their debt, actually went down to under 2.7 billion. How about that?
And this right here is the paradox at the very heart of Archean's story. While the short-term profits were taking an absolute beating, the company's long-term financial health, its actual net worth, was getting stronger. It was literally adding assets while shedding debt. So it now owns more and owes less than it did before. It's kind of a wild contrast, isn't it? So how in the world do we make sense of these two completely different stories? You've got the story of a really tough quarter on one hand and the story of a strengthening foundation on the other. Let's put all the pieces together.
So what did our investigation turn up? Well, if you only look at that headline profit number, you get a pretty scary but also pretty incomplete picture. The full story is way more nuanced. We've got a company that had a really rough quarter operationally, and it got hit hard by this big one-off expense. But, and this is the big but, at the exact same time, it was quietly making its financial foundation even stronger by growing its assets and cutting its debt. It's not just a simple case of profit is down.
And that, of course, leaves us with the ultimate question. Was this all just a one-time thing? You know, a perfect storm of lower revenue and a one-off cost that won't happen again? Or is it a warning sign of more trouble to come? The only way we'll know for sure is to see what the next earnings report says. But for now, we're left with this really fascinating story of short-term pain versus long-term gain.